All right. Hello, everyone. This is Coach McCarthy, and today we're going to start our Unit 3. So, we're going to discuss types of loans. So, let's take a look here. So, there's a lot of different types of loans, all right? Understanding different types of loans, and we're going to come back to these in a little bit, all right? But the main thing we want to talk about first when we talk about loans is we talk about secured versus unsecured loan, all right? So, there are two types of loans, secured and unsecured. Let's go to secured loans require that you offer up something you own of value as collateral in case you can't pay back your loan, whereas unsecured loans allow you to borrow the money outright after the lender considers your financials. So, as we grow up, and as you guys grow up, some things you're going to incur. So, secured loan. Secured loan is a loan backed by collateral. Most common types of secured loans are mortgages and car loans. Those are two things that you guys are going to experience as you start to grow up. And in the case of these loans, the collateral is your home or your car. So, if you don't pay them off, they're going to come take them. So it says, but really, collateral can be any kind of financial asset you own. If you don't pay back your loan, the bank can seize your collateral as payment. So, especially with automobiles, you'll hear about this. When you take out a secured loan, the lender puts a lien on the asset you offer up as collateral. So, LIEN. Once the loan is paid off, the lender removes the lien and you own both assets free and clear. So, they have the lien on it. That's technically theirs. That's your collateral that you've put up in the event you don't pay back your loan. All right, so now we can talk about an unsecured loan. Unsecured loan requires no collateral. All right, so though you are still charged interest and sometimes fees, student loans, personal loans, and credit cards, those are all unsecured loans. We're going to let you take the money. You don't have to put anything up in front of it. All right, so as we're going to talk about, there's no collateral. Financial institutions give out unsecured loans based in large part on your credit score. We're going to come back to credit score and some other units and history of repaying past debts. All right, so your unsecured loans, those are going to have a higher interest rate because you don't have any collateral to back it up. So, coming back to our notes, we talked about first thing we want to know secured or unsecured. Do I have to put up collateral for this or no collateral? All right, so now that we know that, we can discuss our different types of loans. All right, so we have links here. This will go to Google and this will go to Wallet Hub. Let's check out Wallet Hub for today and see what this one has to say. All right. So when we start talking about loans, some things you're going to see the abbreviation APR, all right, annual percentage rate. You're going to see numbers and percentages. You're going to see years, and we're going to talk about those. All right, maybe in some later things, we're going to talk about how we actually calculate interest. I think that's our next thing that we're going to talk about. So right now, we're just talking about different types of loans. Thing you can take away from this article right here, there are some loans that are predatory, all right? That means they're going to take advantage of you. Not worth pursuing, like payday loans and auto title loans. We're going to come back to talk about payday loans, but also auto title loans. Still something important to know about. So when we look at types of loans, I mean, you can see there's a lot: personal loans, auto, student, mortgage, home equity. I mean, you guys can all read those. As we come back and look at my list over here, look, we're going to talk about some of those in a little bit more depth. Auto loan, personal home improvement. So in reality, I mean, if you can think about it, there might be a loan that you can take out for it. So it's just a way for you to get access to more finances, more money. We talked about that you need currency to be able to work in our market. All right. So how are you going to get that money? Well, one way you might get it is a loan. All right. So one of the ones we can take out a personal loan. All right. Most versatile types of loan, providing funds for pretty much any purpose as long as it's not illegal. All right. And we got to make sure about that. All right. So the things that you'll see when we start talking about a loan. Okay. The length. How long do you have to pay it off? 12 to 60 months. What's your percentage rate? All right. And we're going to talk about how you calculate interest and what all that means later. So maximum loan amounts. All right. So there's different amounts you can take the loan out for. And we're going to get into this. A lot of that is determined by your credit score. You do need a good credit score when you're taking out certain types of loans. Collateral required for secured personal loans, not for unsecured loans. Same things that we talked about before. Take out an auto loan where you're going to pay off a car. All right. Now, consequences for not repaying. All right. This is a secure loan. So if you don't pay it off, they're going to come take your car. All right. They are typically secured by the car being financed, meaning that if the borrower does not make their payments, the lender, the bank, or whoever it may be, can repossess the car to get back its money, back. All right. Auto loan rates depend on both whether the vehicle is new or used, yes, and how long the loan lasts for. Okay. There is a lot of in-depth detail about auto loans. All right. You can get them from a lot of different places. When you go to the dealership, they might run your stuff for you. They're going to run your credit. That's the big thing that they're looking at, your credit and your finances. And those are going to impact a lot of these things that you're going to talk about. Your payoff timeline, how long do you want to pay off your loan for? How long do you want to take it out for? What your interest rate is going to be. But here, like we talk about credit score required, for most of them, you might not have to have a minimum, but the better score gets you better terms. So your terms are going to be your percentage rate, how long you have to pay it off, and what your monthly payments are going to be. A lot of you guys are going to hopefully be going to college. You're already in a college course, so that's great. So we talk about student loans. All right. So student loans are going to pay for education and education related costs. It could probably teach a whole course on student loans. All right. There's a lot to that. I'm not going to get into a whole lot of that detail. I'll be more than happy to on an individual basis. So student loans can pay school tuition, housing, food, textbooks, transportation, a whole lot of stuff. These loans are not supposed to be used for costs unrelated to school. And this is the thing, lenders do not monitor how the money gets spent. So with student loans, there's a lot of different places you can take them out from private institutions. Be careful with those, very, very, very high interest rates. You can take them out from the government, which is what most people end up doing. All right, that's your FAFSA that you're going to be filling out. So everyone has to fill out the FAFSA because that's how you get your student loans. So we talk about mortgage loans. That's what you use if you want to buy a house. So mortgage loans allow people to purchase a house without having enough money to pay for it all up front, because most of us don't have the money to pay for a house right now. With a mortgage, the borrower can live in their home before they've paid the full price for it, but the financial institution that issued the loan owns the house until the mortgage gets fully paid off. That's what we talked about before. Lien. Okay, technically I own it, and because I gave you the money, you're giving me the collateral. Mortgages are secured by the house, whichever one you have the address for, or whatever you're putting up. All right, length 10, 15, 20. Mortgage, those are probably going to be your normal terms. Your interest rate is going to vary. And then we talk about different credit score. There are some sources, private companies, and government. We'll talk a little bit about FHA and VA and how those kind of work out. Next one we talk about is a home equity loan. So you're going to have your home that you're going to put up behind it. So usually if you already have some money in your home, you can try and get that home equity loan, because I have money invested in my property. So here we talk about the amount of money that a borrower can take out depends on the equity in their home, which is the house's worth minus the balance left on the mortgage. So you're going to have paid off the mortgage enough and have some worth in the house that you can get some money back out of it. Depending on those values, a home equity loan may offer higher dollar amounts than personal loans. Got to be careful with these because they traditionally do have a very high interest rate. You're going to have a high credit score. And once again, this is a secured loan. So if you don't pay it off, they're going to come take your property. So this is interesting. I don't have a lot of experience with this personally, but a credit builder loan. So basically the way your credit works is it goes on your timely payments. So you can read through this. If you get in trouble with your credit, there are ways to get it better, to get it back. Okay, so basically what's going on here is the bank's going to give you a loan, the financial institution puts money into a savings account, then the borrower pays this amount to the lender plus an interest rate over 6 to 24 months. So a very short time frame, 24 months, 2 years, not very long. The lender reports payments to the credit bureau each month, so that's what's going to build up your borrower's credit history and get your credit score going. That way you can take out some better loans and get better rates. And then at the end, the borrower gets access to the savings account with their funds. So a little bit different process here, that you're not going to get the money until the very end. Loans from friends and family, be very careful with these. All right, friends, family, and money, those don't mix real well. Payday loans, very, very bad. Okay. Payday loans are extremely predatory. They're very bad. They're going after people that they can take advantage of. Short-term loans that must be paid back with interest when the borrower receives their next paycheck. These loans are usually $500 or less. It's a small amount, and the lender will often charge a fee equivalent to a 400%. All right, which means if you take out $5, you're going to pay back 20. All right, this is a very bad scenario. I recommend staying away from these as much as you possibly can. Available to people who have bad credit, and that's who they're preying upon. People that have bad tendencies of paying things back, they're going to keep charging that interest rate. Enormously high cost, they are absolutely not worth pursuing. Auto title loan are going to be the same kind of thing because you're getting a very high interest rate, all right, and fees, and if the borrower cannot pay off the loan, the lender can take their car. Definitely best to avoid these loans. Pawn shop loans, again, another thing. Got to be careful with those. Not going to get into that just a whole lot. loans versus other types of borrowing options. We do have a credit card, line of credit. We're going to talk about here in a little bit. All right, so coming back to our notes here, going to look at Investopedia, see what they got going on. So a lot of the same things, understanding different loan types. So we talked about personal loans and secured versus unsecured, and this will give you some more information on some rates. We talk about credit cards, which technically is a loan, and got to be careful with that because they have some very high rates if you don't pay things off. All right, and a credit card is more of a revolving line of credit. Is kind of the way it works. It's always going to be there as long as you're paying it off. All right, so back to our notes. You can finish reading the Investopedia article. And the next thing we're going to talk about is going to be mortgage loans. So we're going to start with Rocket Mortgage, which is a company that does mortgages for a lot of folks. And they have some good information here. And this is for beginners. All right, only 7-minute read, so pretty quick. So owning a home is part of the American dream. Exactly. Getting a mortgage is one of the steps it takes to get there. Yeah, you got to get a mortgage. So that's what's going to get your house. So here's a simple definition of a mortgage: a type of loan you can use to buy or refinance a home. Right? We talked about you can take out a mortgage against your home. This is more about going to be so that would be we're going to talk about more about buying a home when we talk about a mortgage than we are going to talk about taking out the money against it. So most people who buy a home do so with a mortgage. Necessity if you can't pay the full cost of a home out of pocket. Not a whole lot of us can do that. All right, so they talk about the requirements, and the requirements are going to be different for every loan. The one key things that most people are going to be looking for is that you have a stable and reliable source of income, and that you have a credit score. All right, it can be low, it can be high, or we're going to talk about those kind of as we go. All right, and this is kind of a little bit of how it works. We're going to talk about this. So when you get a mortgage loan, your lender gives you a set amount of money to buy the home. You agree to pay back your loan with interest. That's the big thing you got to watch out for. What your interest rate is going to be. That's the percentage that we've seen and talked about. Over a period of several years, that's going to be the term. You don't fully own the home until the mortgage is paid off. So here we talk about the interest rate, that's our percentage, is determined by two things: current market rates and the level of risk the lender takes to lend you the money. All right, you can't control the market rates. That's something that's controlled by external forces. But what you can control is the risk that they think they're taking in you. All right, so they're going to look at, see if you have any red flag. They're looking at your credit report to see if you can pay back your expenses, and that's going to be your credit score number. All right, they want to see if you are risky or not risky. The higher your credit score, the less your risk. All right, the lower your credit score, the higher your risk is for them. All right, when they look at your risk, then they're going to determine your rate. All right, if you're more risky, you're going to have a higher rate. Not as risky, you're going to have a lower rate, which means you're not going to get charged as much interest. All right, the amount of money you borrow will depend on what you can reasonably afford, and most importantly, the fair market value of the home determined through an appraisal. So appraisal is you're going to have someone come out, look over your property, and they're going to tell the bank whatever they think it's worth. All right, this is a job. People just go around appraising houses. This is a not daunting, but there's a lot to it process. You got to look at the houses around it, and this can be a whole unit on itself. All right. So involved with the mortgage, you have the lender and the borrower. The lender is the financial institution that loans you money to buy a home. Your lender could be whoever: Rocket Mortgage, Quicken Loans, Bank of America. There's a whole bunch of people that can give you the money. All right. The borrower is the individual seeking the loan to buy a home. So who's taking the money out? All right, some things we need to know. When you shop for a home, you might hear a bit of industry lingo, so words you're not familiar with. All right, so amortization. Part of each monthly mortgage payment will go towards paying interest to your lender, while another part goes towards paying down your loan balance, also known as your loan's principal. So the principal is the amount that you took out. All right, and that's usually the amount also that you'll owe back. Amortization, big word, refers to how those payments are broken up over the life of the loan. During the early years, a higher portion of your payment goes towards interest. As time goes on, more of your payment goes towards paying down the balance of your loan. And that's what you want to make sure that you're trying to get to, paying off the balance and not just paying money towards interest. So when we talk about credit cards, we're going to talk about staying away from the minimum payment, because that's what's going to get you in trouble. All right, you're paying the interest, you're not paying the balance. Okay, down payment is the money you pay up front to purchase a home. And you also do, usually you have to do this with a car also too. All right, And they have a calculator that they're going to calculate for you how much you'll need. It's going to vary on the type of loan and also your terms. All right. The more you put down up front, the lower your payments are going to be monthly. The less you put down, the more you're going to have to pay because you're taking out a bigger loan. All right. So the higher the down payment, the smaller the loan is going to be, the smaller the principal. All right. And then escrow, part of owning a home, is paying for property taxes and homeowners insurance. Okay. To make it easy for you, lenders set up an escrow account to pay these expenses for you. Your escrow account is managed by your lender and functions kind of like a checking account. No one earns interest on the funds held there, but the account is used to collect money so your lender can send payments for your taxes and insurance on your behalf. And then you get the documentation that they've paid it, so something you don't have to worry about. Okay, not all mortgages have that. Make sure if you're involved in a mortgage process, you know if it does or doesn't. Right? And what we talked about, interest rate. All right, this is what will get you in trouble if you're not careful. So this is the percentage that shows how much you'll pay your lender each month as a fee for borrowing money. Okay, anytime you take out a loan, you're going to have an interest rate. We're just going to talk about it here because we have some good information. Two types of mortgage. So we're talking about mortgage interest rates, fixed rates and adjustable rates. So with a fixed rate, fixed interest rates stay the same for the entire length of your mortgage. If you have a 30-year loan, 4% interest rate, you're paying 4% until you pay it off. Okay? Or you refinance. I'm going to redo my loan and take out a new rate. So fixed rate loans offer predictable payment each month, which makes budgeting easier. My loan payment, my repayment, is going to stay the same throughout. Okay, you can get a fixed rate with any type of loan that you're going to take out. All right, adjustable rates are interest rates that change based on the market. Remember, you don't control the market. All right, fixed rate period, which usually lasts 5, 7, 10 years, and then it can start to change. If you play your cards right, you might get into a situation where you can have a lower rate, right, which is going to drop your payment. If you play it wrong, it's going to be a higher payment because your interest rate is going to go up. All right, right, for some borrowers, if you plan to move or refinance before, might be okay. Be very careful with adjustable rates. All right, not something you want to play around with. Make sure you understand economics. That's a whole nother course. All right. Loan servicer is the company that's in charge of providing monthly mortgage statements, processing payments, managing your escrow account. All right, this is going to be on the mortgage thing. So when we talk about homes, all right, there's some conventional loans, and we can talk about FHA. FHA loans are a popular choice because they have low down payment and credit score requirements. Get an FHA loan with a down payment as low as 3.5%, credit score 580. All right, backed by the Federal Housing Administration. That's what FHA is. Federal Housing Administration will reimburse lenders if you default on your loan. All right, so that's who's going to back your loan. They're going to help you with that process. Conventional loan, any loan that's not backed or guaranteed by the federal government. That's our conventional. Are often also conforming loans, which means they meet a set of requirements defined by Fannie Mae and Freddie Mac. Government-sponsored enterprises buy loans from lenders so they can give mortgages to more people. All right, this is a big. There's actually a system where they're buying loans and selling loans. We're not going to get into that. That's a little bit farther down the road. So how you're going to get your conventional loan is as little as 3% down. Less than 20% for a conventional loan, you will usually be required to pay a monthly fee called private mortgage insurance. All right, when you're buying a home, right, you got to know this. And you'll have to pay this if you don't put down enough percentage. Some of them, once you get to that, much of an amount that you've invested into your home, you don't have to continue paying that. So once you have paid off once you've paid off 20%, you no longer have to have that insurance. All right. So if you don't have the money to put down 20%, you're going to have to take out mortgage insurance, which is another payment you're going to have to make. USDA loans are only for homes in eligible rural areas. All right. Although many homes in the suburbs qualify, maybe because they're so far out. Your household income can't exceed 115% of the area median income. Okay. So good option for qualified buyers, allow you to buy a home with 0% down. So probably going to be out in the country, which is what we are. So your farms might be in a USDA loan. VA loans are only going to be for military, backed by the Department of Veteran Affairs, benefit of service for those who've served our country. VA loans are great because they zero down, no private mortgage insurance. They have some different terms, and they can work with you a little bit better. So as we've talked about, your mortgage payment is the amount you pay every month toward your mortgage. All right. And this is going to be with any loan. Each monthly payment has four major parts. Okay. So for all of our loans, we have the principal, the interest, our taxes, and our insurance. Okay. Principal is the amount of money you have left to pay on the loan. For example, if you borrow $200,000 to buy a home and you pay off $10,000, your principal is now $190,000. That's how much you owe to pay it off. Part is going to go towards paying down your principal. So you got to be careful when you take out a loan. All right. Some of them have a penalty for paying off your principal early. We're going to talk about that later. So interest rate is how much you pay each month is based on your interest rate and loan principal. The money you pay for interest goes directly towards your mortgage provider. As your loan matures, you pay less in interest as your principal decreases. Okay, so principal's going down. We don't owe as much, not going to owe as much interest. All right, that's what the bank's making. That's why they're giving you a loan. They're charging you interest. We talked about things can be set up in an escrow account, our taxes and insurance. Our terms, usually 30 and 50 years on our insurance. And mortgage process, got to get approved, shop around, find the best one, get a final approval, and then, start paying on your loan. Okay, so good scenario and some good things to know there when we talk about getting a mortgage. So let's go back and we have this one. Let's see if we have anything here on Bankrate. Yeah, so here we are on Bankrate. Now, when you start looking at mortgages, you're going to see these in a lot of places. All right, and I'm not saying this one's the best. They're all pretty much the same. And honestly, this is an advertisement from another company. That's a whole other story, or advertisement for other companies. So what you would do is purchase amount, refinance, zip code where you want to buy it at, because those rates do depend on where it's at, what your credit score is, okay, how much the property's worth. All right, that's the appraisal. How much do you need a loan for? All right, what's your down payment going to be? And then for how long it's going to be. And they do a pretty good job of breaking it down. Now, when I was growing up, we didn't have all these things. We didn't have the internet. You had to know all this stuff. Now, they got a website that'll tell you how to do it. All right, so here's our interest rate. That's pretty good interest rate. All right, and then here's our monthly payment. All right, now, remember, this could change. All right, if you don't have enough 20%, well, if we have 20%, we're good. So we don't have to have insurance. All right, so we talked about conventional, adjustable rate. Those are the ones that are going to be moving around. We got to be careful with those. Fixed rate doesn't change over time. Government insured mortgages, we talked about the FHA, VA, and USDA. And briefly here, we're going to talk about jumbo mortgage. All right, borrowers who need to take out more money than the federal limit for a standard mortgage. Surprisingly enough, there is a federal limit for how much you can take out. All right, so here we go. There are two types of conventional loans, conforming and non-conforming. A conforming loan simply means that the loan amount falls within the maximum limits set by the Federal Housing Finance Agency. Okay, the type of mortgage loans that don't meet these guidelines are considered non-conforming loans. Jumbo loans, because it's big, which represent large mortgages above the FHFA limits for different counties, are the most common types of non-conforming loan. All right, so good things about your conventional and bad things and who should get one. All right, if you have the money and you have a property you like, all right, might be for you. Jumbo mortgage for 2021, the maximum conforming loan limit for single-family homes in most of the U.S. is $548,000. That's a lot of money. In certain high-cost areas, the ceiling is, I would say this would be like California, New York, $822,000 and some change. Jumbo loans are most common in higher cost areas and generally require more in-depth documentation to qualify. If you're getting $822,000, they're going to need a lot of documentation. You better have a good job and a really, really good credit score to take out that much money. All right. So government, we talk about FHA, all right, Federal Housing Administration, USDA, U.S. Department of Ag. That's why we look at those as being more of a farmer type loan, all right, or someone that might be opening a farm, and the U.S. Department of Veterans Affairs, okay, VA loans. We talked about FHA, backed by the government, help make ownership possible for borrowers, don't have a big down payment, and don't have good credit. Right? So if you don't have good credit, you might be into an FHA. USDA, moderate low-income borrowers buy homes in rural areas. All right, meet certain income limits to qualify. And then VA is going to be for veterans. All right. And moving forward here, our fixed rate mortgages keep the same interest rate over the life of your loan, which means your monthly mortgage payment always stays the same. That's probably what most of us are going to be involved with, where it's going to be staying the same. We're probably not going to want to get too much involved with adjustable rate mortgage unless you really understand economics and you have a good trust in that it's going to go low. All right, there's some other types of loans which we've talked about. Construction loan, if you're going to build a home. All right, yeah, we didn't talk about this. What if you're going to build a home? Well, you got to buy the property, then you got to have the construction loan to be able to build the loan. That's not going to be a traditional mortgage loan. All right, that's going to be taking out something else completely different. And here's a video. Yeah, you can hear him explain it instead of hearing me. All right, if you want to read the Wikipedia, there's Wikipedia. So we talk about fixed rate, we talk about variable, adjustable rate, and we talk about amortization. All right. Moving forward, we have auto loans. If you want to click on this, we can come here and look at auto loans. There is a whole bunch of things you can apply for. All right, good credit, bad credit, auto loan. Again, secured. You got to put up your car behind it. Things you want to watch out for, there's a lot of them. Okay, be careful when you're taking out an auto loan. You can get yourself in some trouble real quick if you're not sure about rates or the price of the car or how long. I mean, there's pitfalls. They don't mention about the best car loans. I highly recommend if you're going to be taking out a loan, make sure you do your research. Okay, check out some of these articles and read up on things. All right, don't put yourself in a bad scenario. We talked about personal loans, and here's a bunch of places that best place to get a personal loan. So some places that you can get a personal loan from if you need one like that. As we see right here, a lot higher percentage rates. Right, 5.74. That's a pretty high amount of interest they're going to charge. We have home improvement. All right, best home improvement loans. Again, you can take them out from a lot of places. So businesses, we talk about line of credit. That's going to be usually your SBA, the Small Business Administration, is going to issue those to a business. All right, and you can get a small business loan from a lot of different places if you're interested in starting a business. All right, next day advance. All right, we talked about these, and I have a link here to Credit Karma. Cash advance loans, 4 reasons to be cautious. All right, we talked about these. All right, come with finance charges, maybe upwards of 500%. Okay, very, very short terms to pay it back. Expensive fees can trap you in debt. Yeah, they'll get you in fees alone. No credit check, but also, it's not going to help your credit, and you can get in trouble because you have to pay back so much money. Okay, again, I recommend staying away from those as much as you can. Credit card. You're getting to the age where people are going to be offering you credit cards left and right. Okay, you have to pay that money back. It'll stay with you for forever. All right, be careful of taking out too much credit. You can't have too many credit cards, which is a bad thing because you're going to end up paying a lot of money if you're not careful. All right, make sure you're keeping track of your stuff and your records. We're going to talk about those at a later date and time. A swing or a bridge loan. All right, also known as interim financing, gap financing, or swing loans, bridge loans. Bridge the gap during the times when financing is needed but not yet really available. All right. Or company secures permanent financing or removes an existing obligation. All right, it allows the user to meet current obligations by providing immediate cash flow. Bridge loans are short term, up to 1 year, relatively high interest rates, and are usually backed by some form of collateral, real estate or inventory. Okay, just a short term loan that you're going to take out and you're going to try and pay it back real quick. All right, so bridge loan is a short-term financing used until a person or company secures permanent financing or removes an existing obligation. The one place that you'll probably see that the most, this here, number 4, homeowners can use bridge loans toward the purchase of a new home while they wait for their current home to sell. So if I'm selling my old home, I have some collateral I can put up, I know it's going to sell, and I'm going to be able to pay that loan off while I buy my new home. Another type of loan, depending on where you work, and I have had this where a company bought me some work shoes and then they're basically loaning you that money and then they take it out of your check the next time around. So that's kind of the company can loan you something. We talk about the last 2 things we're going to talk about: open-ended and closed-ended loans. All right. So we talked about secured and unsecured. And the last things that we're going to finish up with is we talk about open-ended credit and closed-ended credit. And maybe should have moved this up to the front. So open-ended credit is a pre-approved loan between a financial institution and a borrower that may be used repeatedly up to a certain limit and can subsequently be paid back prior to payments coming due. The pre-approved amount will be set out in the agreement between the lender and the borrower. Open-end credit is also referred to as a line of credit or a revolving line of credit. All right, so if I take out $1,000 from the bank, I have a line of credit for $1,000. I can go say I need $500 right now. They'll give me the $500. I have to pay back the 500, and the interest rate that they're going to charge me is based upon that 500. Now, I can't take out any more than another 500 because I took out half of my 1,000. Now, if I pay my $500 back and wait another month and hey, I need to take out more money, I can take that out because I have that line of credit. It's revolving, kind of like a credit card. Credit card is open-ended credit. When you take out your mortgage, that's close-ended, okay? You can't come back and say, hey, I need some more of that money though. All right, it's been a long unit, and let's finish this off real quick. So, things you have to be careful about. There are some loans that have prepayment penalties. Okay, make sure you understand when you take out your loan if it has a prepayment penalty. Some of them have one. Okay, I got some money. I want to pay off all my loan right now. Okay, cool. We'll take all your money. We're not going to charge you anything. Some of them say, well, that's fine. You can pay it off, but we're still going to charge you X amount of dollars. Okay, so that is something that's negotiated in the terms before you take out your loan. Make sure you understand that process. All right, that'll finish us up with discussing types of loans. There's a lot.